In the spring of 2000, something happened that no one fully understood until years later. The NASDAQ, the index that housed the future, had risen 450% in 5 years. Every week, a new company went public with no revenue, no profit, and a valuation larger than General Motors. Analysts called it the new economy. Professors wrote books about it. Investors borrowed money to buy more. Then in April of 2000, it stopped. Not slowly. Not with warning. $5 trillion in market value disappeared in 18 months. Companies that had been worth billions were worth nothing. The technology was real. The internet did change everything. And people still lost everything. Here's the question this documentary asks, and does not answer. The mechanism that built the dot-com bubble did not disappear in 2000. It was dormant. And in 2024, the same architecture, the same financial structure, the same psychological pattern, the same tolerance for valuation without foundation is active again. The instrument is different. The pattern is the same. What does history show us about what happens next? Bubbles do not begin with fraud. They begin with something true. In 1995, the internet was real. It was going to change commerce, communication, and the structure of every industry on Earth. That was not speculation. That was fact. The mistake was not believing in the technology. The mistake was believing that every company touching the technology was therefore worth any price. The mechanism worked like this. Interest rates were low. Capital was cheap. Venture funds raised billions and deployed them into companies whose primary asset was a domain name and a business plan. Institutional investors, pension funds, endowments, mutual funds, followed. They had to. Their competitors were posting 30, 40, 60% annual returns. Sitting out meant falling behind. This is the structural dynamic that financial historians call the momentum trap. The more capital flows in, the higher valuations go. The higher valuations go, the more capital flows in. It is not irrational at the individual level. Every participant is responding correctly to the incentives in front of them. The system, however, becomes structurally unstable. By 1999, the NASDAQ was adding $200 billion in market capitalization per month. Companies with zero revenue were worth more than Sears, Boeing, and General Mills combined. The metric that had governed equity valuation for a century, the price-to-earnings ratio, had been formally abandoned. Analysts invented new metrics: eyeballs, page views, first mover advantage, anything to justify the number on the screen. There was one company that seemed, to many observers, to be different. Cisco Systems did not sell promises. It sold the physical infrastructure of the internet, the routers, the switches, the hardware that made data move. If the internet was a highway system, Cisco was building the roads. The logic was simple. Whoever wins the internet will need Cisco's equipment. Therefore, Cisco was not a speculation. It was a certainty. In March of 2000, Cisco briefly became the most valuable company in the history of the world. Its market capitalization reached $555 billion. Its price-to-earnings ratio was 131. For every dollar Cisco earned, investors were willing to pay $131 to own a piece of it. What followed has been documented carefully. Over the next 2 years, Cisco's stock fell 89%. Not because the internet failed. Not because Cisco's products stopped working. The technology was indispensable. The infrastructure was real. but the valuation had been built on a projection of growth that the laws of arithmetic could not sustain. When capital stopped flowing in, the number had nowhere to go but down. The trail continues. In 2024, there is a company that sells the physical infrastructure of artificial intelligence. NVIDIA does not make artificial intelligence. It makes the chips, the graphics processing units, that every artificial intelligence system in the world requires to function. OpenAI runs on NVIDIA. Google runs on NVIDIA. Microsoft runs on NVIDIA. If artificial intelligence is the new internet, NVIDIA is building the roads. The logic is identical. Whoever wins artificial intelligence will need NVIDIA's hardware. Therefore, NVIDIA is not speculation. It is a certainty. In 2024, NVIDIA's market capitalization exceeded $3 trillion. Its price-to-earnings ratio reached over 70. For every dollar NVIDIA earned, investors were willing to pay $70 to own it. The technology is real. The demand is real. The question that financial history keeps asking, and that very few people are asking publicly right now, is not whether artificial intelligence will change the world. The question is whether the current valuation reflects what NVIDIA will actually earn, or what investors believe NVIDIA will earn in a future they have already priced into today. In 1999, that distinction seemed academic. By 2002, it was everything. There is a ratio that financial historians use to identify structural instability in equity markets. It is not complicated. It is the relationship between what a company is worth and what it actually earns. When that ratio reaches extreme levels, historical evidence shows that mean reversion follows, sometimes slowly, sometimes suddenly, always eventually. At the peak of the dot-com bubble in 2000, the NASDAQ Composite traded at a price-to-earnings ratio of approximately 200. Every dollar of collective earnings supported $200 of market value. The structural instability was not hidden. It was in the number. But the number had been there for 2 years before the break came, long enough for most participants to conclude it was the new normal. The artificial intelligence segment of the current United States equity market is trading at ratios that, in aggregate, the historical record has seen before. Not in 2015, not in 2010, in 1999. The technology was real then. It is real now. Cisco fell 89%, while the internet kept growing. Financial history does not offer predictions. It offers patterns. The pattern of 2000 was not that the internet failed. It was that the mechanism for pricing the internet, cheap capital, momentum-driven valuation, structural tolerance for earnings multiples that arithmetic could not sustain, eventually collided with reality. Not because the technology disappointed, because the number had nowhere left to go. We do not know when that collision, if it comes, will arrive. We do not know how large it will be. Financial history shows us the structure. It does not show us the date. What it does show us is this. Every generation that has lived through a structural, technological shift has believed, with reasonable evidence, that this time the rules were different. Every generation has been partially right. The technology did change everything. The valuation was still wrong. The question is not whether artificial intelligence will transform the global economy. It will. The question is what you're actually paying for, and whether the number on the screen reflects the future that has been promised or the future that arithmetic can support? That is a question the market has answered before. The trail doesn't end here. If you want to be there when the next trail is uncovered, the notification bell is the only way we can guarantee you'll know.